Hey everybody, how you doing? It's Bruce here, Stock Markets with Bruce. Welcome to my channel. Thank you all of you out there who are subscribing to my stock market channel. I love you guys for that. Thank you for the thumbs ups and all of you making donations on PayPal, and you're wonderful. Thank you for joining me live every day on what's happening in the markets. We try to explain what's going on in plain English, and I thank you all for your support and following me on this channel. Beautiful. I wanted to talk today about explain a little bit about hedge funds. A lot of people are asking me about hedge funds because in the news the last few weeks, they have really dominated a lot of coverage, and a lot of people do not know just how complicated and how diverse hedge funds really are. And I'm going to try to explain this in a simple, plain English kind of a way. The bottom line is this. What is a hedge fund? Tell me about hedge funds. How many are there? 10 to 15,000 is how many exist globally. That's an estimate. How much money do they manage? Rough estimates, last report a few years ago, over $3 trillion. And as the higher the markets go, the higher these dollar amounts run up. So if the Dow Jones and the NASDAQ and the S&P 500 indexes are hitting record highs, and they're kind of close, then it is a pretty safe bet to say that they're well over 3 trillion, maybe closer to 4 trillion under management around the world. It's an amazing amount. Who invests in hedge funds? Hedge funds are not for you and I, the average investor. Hedge funds are reserved for large investment entities, like, for example, high net worth individuals, and we're talking about 100 million or more to really get into a lot of these hedge funds. And even then, that might not be enough as for one individual to get involved. There are pension funds investing in hedge funds, many of them, many pension funds into many different hedge funds to diversify their interests. The banks, they invest. Credit unions, insurance companies, mutual funds, endowment funds. You know, these universities out there, they talk about, university such and such in the United States has a $3 billion endowment, or this one has a $500 million endowment. Those dollars are put to work to grow larger, so that the growth can keep up with inflation, and these endowment funds can keep piling up cash so that the universities can keep expanding their grounds or modernizing their facilities and keep up with inflation and offer more and more free tuitions and scholarships and all of that. So these endowments invest into a myriad of hedge funds to grow and diversify their investments. They need professional management. REITs are another area of money coming in. Pools of capital around the world. There are ways to invest. For example, if you win the lottery, let's say you win the Powerball, and you win a $500 million Powerball, and you decide to take the money all in one shot, and they give you $280 million, but the tax man takes some away, and you have $150 million left. You might or might not have enough money to buy into a hedge fund on your own. But what you can do is you can invest in a hedge fund management company that invests into a variety of hedge funds for you. So they pool people's cash together, and they'll pool together $1 billion from 50 different investors. And every quarter, so every 3 months or so, they got another $1 billion pooled in, and then they put the $1 billion into 20 different hedge funds, wide diversification of hedge funds. And that's how you, as a lottery winner, can get into 20 different hedge funds through one hedge fund. That is offered as well. How are hedge fund managers paid is a big question. Hedge funds charge a fee to their investors, usually of between 1% to 4% a year on the value of the money being managed as an overhead charge. And that is taken out on a monthly basis. So if you're an investor in a hedge fund that's running with $10 billion, it could be that there's a 2% management fee, and they divide that into 12, and 1/12 of that, the value at the end of the month, they take 1/12 of 2% and deduct that from the money that's sitting in the fund as a monthly fee. That pays the rent for the offices of the hedge fund. It pays the salaries of the receptionist and the office managers and all the costs and the electricity bills and the property taxes and all the expenses of running a hedge fund, including brokerage fees, trading fees, banking fees, auditing fees, on and on and on it goes. So at 2% of $10 billion, that's a lot of money, but that shows you how expensive it is to run that big a fund that might be into 100 different investments at the same time. A lot of staff and a lot of overhead. But there's more. Hedge funds get paid. Managers of hedge funds, in other words, the key people who run the fund, they get paid a bonus based on how well the fund does. And that can run from 5% of the profits up to 40% of the profits, even 50% of the profits. It's not uncommon, though, for a lot of hedge funds to have a 20% profit rule, where the first 5% that is made in profit goes back to the investors, right back to the investors. Managers get nothing. Over 5%, then there kicks in at a 20% payout to the managers. So if a hedge fund makes 25% profit in 1 year, then the first 5% goes to the hedge fund investors, pure 100% payout to them, and the next 20% of that goes to the managers, and 80% goes to the investors. And that is an incentive for the managers of these hedge funds to make a lot of money with that 10 billion or 5 billion or 16 billion dollar, whatever the amount is. Make a lot of money, and you could be paid a lot of money. Some of the richest people in the world are hedge fund managers. They own a big stake in the hedge fund themselves. They've put their own money on the line. They literally just reinvest their profits back into the hedge fund to become some of the largest investors in their own hedge funds. And that gains more confidence with other investors who want in, because they're going, hey, if this guy is making 25% on the money and a quarter of all the money he's managing is his money, I want to put my money in there with this horse. I want to bet on this horse going forward. So the more you make, the more you attract, and the larger your hedge fund gets. Some of the biggest operators of hedge funds, I've got a list right here. I'll just read these up. Some of the biggest investors are George Soros, the biggest managers. Steve Cohen from Point72. George Soros owns Quantum Group of Funds. Ray Dalio, Bridgewater Associates World Management Fund, 160 billion under management in 2017, the world's largest hedge fund at that time. Steve Cohen with Point72 just invested $2.75 billion with Ken Griffin from Citadel, another hedge fund, into another hedge fund called Melvin Capital that just lost billions of dollars trying to short GameStop shares. So hedge funds invest in other hedge funds because they like the management, even though sometimes managers make mistakes. They get in when the going is tough, and they make money with them going forward. John Paulson, who made all kinds of money on the housing crisis in 2008 and 9 when he bet against the housing market, he has a $19 billion hedge fund called Paulson & Company. Dave Tepper runs a fund called Appaloosa Management. Daniel O-C-H is the spelling. He runs O-Ziff Capital Management, $40 billion in that hedge fund. Very diversified. Leon Cooperman, Omega Advisors. He's on CNBC a lot. He's running billions of dollars. Paul Singer, Elliott Management Group, $23 billion hedge fund in 2013. Plus, he runs another portfolio of $8 billion more as of 2015. David Einhorn with Greenlight Capital is in the news all the time. And Bill Ackman is always in the news with Pershing Square Capital Management. These are just a smidgen of some of the most famous names out there. Many, many hedge fund managers. You wouldn't know them if you bumped into them on the street. They don't look any different than you and I, and yet they manage billions of dollars for clients. Many of them are based in New York, as I say, London, other major centers around the world. They're also incorporated in places like Bermuda, the Cayman Islands, Switzerland, and other tax-free locations. and they run the gamut as to what they invest in. Hedge funds will invest in real estate ventures. Don't be surprised if someday you're in New York and you're walking by a skyscraper going up that's 80 floors high, or you might be in Dubai, or you're in Paris, or wherever you are. You'll find skyscrapers going up, and on the ground floor are those giant billboards telling you the name of the building when it's all done, a picture of what it'll look like. And then in the fine print, you might notice some of these names that are backing the projects, serious banks, and then hedge funds start popping up. You'll see all kinds of hedge fund names that are involved in the development of a $500 million skyscraper, or a giant industrial park in Shanghai or in Hong Kong, another skyscraper going up. Hedge funds are into everything. They buy stock, they short stock, they go into futures, they're into derivatives, they currency trade, they are into bond trading, whatever financial business is being conducted globally, they're into it. And some of these large hedge fund managers are personally contacted by the heads of banks, of countries. So Secretary Treasury people for many countries talk to hedge fund people one-on-one for private consultation as to what they think is going on in the global economy and currencies and interest rates, you name it, because these folks are managing multi-trillions of dollars out there, and everybody wants to know what everyone else is thinking as to what's going on. So there's some of these folks are really sharp. They went to school and they studied, and they're applying their trade in the hedge fund business. So there's a little snippet for you of the overall hedge fund world that exists. So don't think that just because a stock like GameStop has a run from $10 a share to $400 a share, and a couple of hedge funds lose a couple of billion here and there, even if they lose $15 billion, they're not going anywhere. With trillions of dollars of capital behind them, these outfits are extremely well funded. But it is true that every year, certain hedge funds shut their doors because they just couldn't make it work. Others stop taking investment money in because they don't need any more. Others start handing money out because they don't want to diversify and continue forward, getting larger. It always changes over. It's quite normal. The hedge fund world is a very complex and deep world in which to follow, but it is a fascinating world, and it is very necessary in the operation of the stock market, the options market, the commodities market, the currency market, the bond market, you name it, anything you can trade. Hedge funds are part of the game, and the liquidity is very welcome, and it's what makes this world work overall. I hope you enjoyed this video today. Thank you for joining me about hedge funds in plain English with Stock Markets with Bruce. Thanks again for subscribing to my channel. Thank you, all of you who are picking up items like these on my Redbubble store. You can pick up Stock Markets with Bruce merchandise. More and more will be listed all the time. Thanks for the thumbs ups. Thank you for your comments. And join me live during the market hours when I'm live talking about what's going on in the markets in plain English. And I welcome you to come and visit me anytime. Thank you, everybody, for joining me today. Take care.